Hello everyone. Today we are talking about Hindustan Unilever. The name is everywhere in India, right? From your soap to your tea. Chances are you're using an HUL product multiple times a day. It's a titan of Indian business. But what happens when a giant like HUL decides to chop off one of its own businesses? And we're not talking about just any business. We're talking about one of its most loved, most nostalgic brands. So for people who want a quick answer, here's the shorter version. Hindustan Unilever is spinning off Quality Walls, the brand behind Cornetto and Magnum, into a totally separate company. This isn't just some corporate reshuffle, it's a multi-billion-dollar strategic divorce. And the decision has already been made. The big question is why? Why now? I've done a lot of research on this, so I'm going to take you through it. This is either a genius move for investors or a very, very big mistake that could hand the entire ice cream market to rivals like Amul. So let's get into it, okay? So let's start with the fundamentals because this is where many of us would fall. On the surface, it seems weird, right? Why would a company built on a huge integrated portfolio just break it apart? To understand this, we need to look at both the global picture and what's happening in India. This isn't just an HUL India story. It's part of a huge global strategy by its parent company Unilever. In simple words, Unilever globally wants to become a simpler, more focused company. And the ice cream business, with its unique demands, just doesn't fit neatly with soaps and soups. Their leadership has pointed out that ice cream is a completely different beast. Okay, it needs a special cold supply chain, demand is seasonal, and the profit margins are lower than their other products. For a giant conglomerate, it's an outlier. So the global mothership decided to spin off its entire ice cream division, and HUL India is following that plan. But the Indian context adds another layer here. The Indian ice cream market is a gold rush about to happen. It's currently valued at around 30,000 crore and is projected to explode in the coming years. Now, you will see that Indians have one of the lowest per capita ice cream consumptions in the world. That gap represents a massive untapped opportunity, right? The problem is this opportunity has attracted fierce competition. Amul is the undisputed king. Then you have strong regional players like Vadilal and Havmor who defend their turf like crazy. In this hyper-competitive world, HUL's ice cream business, which is only about 3% of its total revenue, was getting lost in the shuffle. It was a small fish in HUL's gigantic pond. So the leadership looked at this and decided their ice cream division needed its own army, its own general, and its own money to fight this war. The argument for smart move. Okay, so is setting quality walls free a stroke of genius? The arguments for it are pretty strong and they all come down to one word: focus. First, let's talk about focus and agility. For decades, Quality Walls has operated under the massive HUL umbrella. This gave it stability, but it also meant bureaucracy. Decisions had to go through managers who were probably more worried about shampoo or tea. A standalone company can be laser focused on just one thing: selling ice cream. It can react faster to trends, launch new products quickly, and build a culture for the fast-paced food industry. It can innovate at the speed of taste, not at the speed of a conglomerate, right? The second, and this is the most important point, is unlocking value for investors. HUL is a high-margin business. Ice cream is a low-margin, high-capital business. When they were lumped together, the ice cream division was seen as a drag on HUL's overall numbers. By separating them, you create two distinct investment stories. Investors who want the stability of HUL's main business can stick with that. And investors who are excited by the high-growth Indian ice cream market can now invest directly in the new company, which will be called KWIL. For existing HUL shareholders, it's a direct win. They get one share of the new company for every HUL share they own. Analysts believe that as a standalone player, KWIL could attract a much higher valuation than it ever could inside HUL. Management is so confident they think the business could double in the next 2 to 3 years. Finally, the new KWIL will have a dedicated leadership team whose only job is to win the ice cream war.
they won't be distracted. And they'll still have the backing and global R&D of Unilever's massive global ice cream entity. So they get the agility of a startup with the resources of a giant.
The argument for big mistake. But this high stakes bet is far from a guaranteed success. There's a very real possibility this could be a historic mistake. The single biggest argument against it is the loss of synergy. Hindustan Unilever is not just a company, it's a machine. An unbelievably efficient machine for getting products to every corner of India. Its distribution network is legendary. Quality Walls has benefited hugely from this, basically getting a free ride on the same trucks that delivered Surf Excel in Lux. Now, as a separate company, KWIL has to build a huge part of this network from scratch. Can a brand new, smaller company replicate the distribution muscle that HUL took decades to build? That is a monumental challenge, boss. The second major risk is vulnerability. Life outside the HUL fortress will be cold, okay? Ice cream is a tough seasonal business where sales can tank in the winter. Inside HUL, a bad quarter for ice cream could be absorbed by profits from other categories. On its own, KWIL is completely exposed. A single bad summer could have a devastating impact on its performance. It will have to fight Amul, a behemoth, and nimble regional players head-on without the HUL shield. And finally, we can't ignore the sheer complexity of actually doing this. A demerger is like performing open heart surgery on a company. You have to untangle decades of shared services, from finance and HR to IT systems. The whole thing is expected to wrap up around late 2025 or early 2026. If the execution is fumbled or if key people leave, KWIL could be crippled before it even gets a chance to compete.
Conclusion and verdict. So, we're at a crossroads. On one hand, you have a focused, high-growth ice cream company. On the other, you have a brand ripped away from its support system and thrown into a brutal market. So, what's the verdict? Smart move or big mistake? While the risks are significant, I feel that the logic behind this is sound. This is a calculated and likely smart gamble. The Indian ice cream market's growth potential is simply too massive to ignore. Keeping the business inside HUL, where it was a low margin afterthought, was arguably the riskier long-term strategy, condemning it to lose ground to more focused competitors. By setting it free, HUL is giving Quality Walls a fighting chance. The fact that shareholders approved it with a 99.99% vote shows that the market agrees with this logic, right? The move lets HUL focus on its core business while giving investors a direct bet on a pure play ice cream growth story. The future of KWIL will now depend entirely on its new management and their execution. It's a bold move, but in modern India, sometimes the boldest move is the smartest one. But that's my analysis. What do you guys think? Is HUL's decision to spin off Quality Walls a masterstroke or a massive blunder? Let me know your thoughts in the comments below. And for more deep dives into the biggest business stories shaping India, make sure you subscribe to the channel. Thanks for watching.